Welcome, everyone. My name is Nikki Johnston, and I'm with Transition Advisors. Our webinar today is Keys to Transitioning and Retaining Clients and Staff Through a Merger or Acquisition. Before we begin, we need to cover a few important items. First, please close all programs running on your computer. This will help to ensure quality presentation and reduce any audio issues. Transition Advisors, LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. In order for you to receive your CPE credit for today, you must complete 2 requirements. First, you must participate in 3 of the 4 polling questions throughout the presentation, and please note that GoToWebinar does monitor your participation in the polls. Next, you must complete an online evaluation. If you registered for today's webinar through Transition Advisors, you'll receive a link to that evaluation in an email later this afternoon from me. Once both of those requirements are met, your CPE certificate will be emailed to you within 10 business days. In order to fully participate in today's webinar, please familiarize yourself with the GoToWebinar control panel on the right-hand side of your screen. The orange arrow at the top of the control panel will minimize it. During the presentation, all participants are muted, but you can communicate with us by using the question box toward the bottom of the control panel. Just type your question in the box and click Send. Questions are important to us, and time permitting, our presenter will answer all of your questions today. Now, before I turn it over to Joel, we will go ahead and do our first polling question. You can see here that the first question is, how many partners are in your firm? So the options are 1 to 2, 3 to 8, 9 to 20, or 21 plus. I'll give everyone a few seconds to indicate their answer here. Okay, it looks like we have nearly everyone. I'll share the results. 70% of the folks on the call today have 1 to 2 partners. 16% have 3 to 8. Another 10% have 21 and above, and then the remaining 4% are in that 9 to 20 range. As a reminder, you've received a link to download a copy of today's slides in the reminder email, but I've also just sent it via the chat function in case you'd like to click on that and follow along. Now I'd like to introduce our presenter for today's session. Joel Sinkin is the President of Transition Advisors. Thanks so much for joining us today, and enjoy the webinar.
Okay. Show my screen. And are we there, Nikki?
Yes, I see your screen, Joel. We're good.
Great. Hello, everybody, and welcome. For all of those who attended CPE I've taught in the past for the AICPA or anyplace else, welcome back to Elm Street. I'm still Freddie. Today is what to me in many ways is the most important topic to discuss as it relates to mergers and acquisitions of public accounting firms. What I've found, and I've been involved for 25 years exclusively doing mergers and acquisitions in the accounting profession, what I find is everybody focuses very hard on making the deal happen and not nearly as hard on making the deal work. And the reality of any accounting practice deal, the most important measure of success of any merger or acquisition, for the most part, I shouldn't say any, but most of them, is client and staff retention. If the clients and staff are retained, the revenues are there, all the expectations and cash flow charts and all that hard work everybody did on paper is going to come to realization. Conversely, if we lose clients and staff that we needed to retain, the deal is going to obviously be far less successful. So today we're going to focus quite a bit of our attention on what are the key items that are going to help us in retaining clients through a merger or acquisition. One of the challenges we'll have up front is that we have a very diversified group with us today. About 85% of you are small firms, and about 15% are large firms. And there are very important differences in the two. For example, very large firms, top 100 firms, many of those clients are brand loyal. If a partner from Grant Thornton retires and they slap somebody else in there, most of the clients are loyal to Grant Thornton, not necessarily the individual partner. The smaller the firm, the higher the probability that the clients are partner loyal. So we're going to try and talk to both, so give everybody a little bit of hints on everything. I never like to turn a CPE class into an infomercial for a company. But I do often get asked, what is the perspective of the speaker? I'm the president of the Transition Advisors. We touch about 75 deals a year that we consult on, ranging from top 100 to small 1, 2, 3 partner firms. So this is the only thing we do. I've been doing it for 25 years. What we talk and teach about is when you've been involved in over 800 closings of accounting firms, you see so many things that go right, and you see a lot of things that go wrong. Fortunately, you're listening to me in 2015, not 1990. So what we're hoping to be able to do is give everybody a heads up of what we're seeing that's working and what's not. Terry and I are the main principals here, and the rest of these critical people listed here are all the partners and managers of varying areas. Enough of the infomercial. Let's talk about retaining clients and staff. First thing, as I say so often, is if there's 50 things you need to think about in any transaction, the smartest person in the room is going to usually think of 35. We're not going to get you the 50 today, and the reason for that is the uniqueness of each practice and situation. You could take 2 practices with the same amount of partners, same amount of revenue, and there may be nothing else the same about them. So what we're going to talk about are parameters today, but you always have to keep in mind there's a lot of exceptions to rules, but that's where common sense hopefully prevails. When we're starting to talk about a transition plan, there's a lot of different aspects to it. Now, I'm not going to be discussing today, because this is a 1 CPE class, a 50-minute plus session. We're not going to be able to spend a lot of time on integration, which is a different, more from a technology and business and things like that. We're focusing on client and staff retention. So really what we need to focus on is communication. How do we communicate the right message, and what is the right message to send to clients? What is the right message to send to staff? And what you'll find is we're going to back into constantly trying to use the concept of specialization as a justification for what we're doing in all situations that apply to that. And we'll give you more specific details of that in a moment. But I think one of the things that people also don't give enough attention to is how to determine the right successor firm. Most mergers, 99%, aren't mergers of equals. So there's usually a clear successor firm. So if I'm merging up, whether it's for growth, succession, or a combination of growth and succession for some of our partners and others, and people say, well, how could that be? That's one of the most frequent situations I run into. Just this morning, I was on a consulting call with a 6-partner firm. One partner wants this to be their last tax season. Another partner wants to go 2 to 3 more years. The third partner wants to go to 5 to 7 more years. The rest of them are all in their 40s. But they lack the capacity to replace the 3 partners that are looking to slow down. So there you have some firms, some members who are going to look at their ultimate merger as a succession plan, the others a growth plan. So it all starts by choosing the right successor. And there are, other than the fact that, hey, this is what I am, this is what you are, this is what I want, can you accomplish? There's little things you want to think about that, again, I find falls through the cracks. So we want to look at those as opposed to the obvious things. One of the very first questions I would ask as a mergee or a seller is why the larger firm wants to do a merger. A lot of times you get fantastic reasons. Hey, I don't have a presence in this marketplace, I'd like one. You know, we have some great staff, we have some excess capacity, I want to promote some to partners, a merger or an acquisition is going to put me in that position. We have cross-selling opportunities, so many great reasons. But sometimes you hear something that should give you a red flag. And that's basically what I call overhead dump mergers. Just last week on a conference call with someone who reached out to us, and they said to me that they were looking to merge in a firm, and when I asked them why they wanted to merge, their first was almost alluding to the fact, well, everybody is. That's just not a great answer. The second answer was even worse. He said, well, we have a lot of extra space. We have some extra capacity on the staff, And what I was really thinking was if I merged in a firm, basically that would reduce my overhead because I could spread it out thinner. And what I said to him was, a merger is a marriage. We spend more waking time with our partners than our spouse. If all I want is overhead reduction, sublet space. You can live with someone without getting married. But a merger is much more than that. A merger is us being all for one and one for all, so to speak. So why does the other firm want to merge? Do they have the capacity from a staff and space perspective to take us on? So for example, if I'm a three-partner firm and I'm looking to merge into a larger firm, and two of the three of our partners are looking to slow down, and one of our main managers is looking to slow down, and I merge with a firm that doesn't have excess capacity on a partner and a manager level, I'm not fixing the problem. So I chose the wrong successor. You know, I was teaching a CPE class for the AICPA a few months back when I was talking about one of the keys of choosing the right successor and it was continuity. And before I went further, a gentleman raised his hand and said, well, I got an $800,000 practice. Does that mean I should sell to another sole practitioner doing $800,000? And I said to him, how much excess capacity do you have right now? And he laughed. He said, none. I said, so how would someone in your position be able to replace you? So we need to identify, hey, why is this other firm looking to merge? Do they have the staffing on a partner and staff level to replace the people, if any, that are looking to slow down? Do they have that capacity? Do they have the space requirements that it takes to move us in if that's what's going on? Believe it or not, I'm finding that technology is becoming its own culture right now and becoming an important criteria in certain mergers. I'll give you a great example on the large scale, even though most of you are small because we're going to spend most of our time on a small scale. But I recently had a firm come to me, and that's a top 100 firm, that said, I want to go into New England, and I'm not there. But if, let's say you found two firms, Joel, both the same size. One, the metrics are really good, but they're not paperless, they're not on the cloud, they don't have multi-screens. The other firm has poorer metrics, but they're all the way there in technology, portals, everything. I'll take the firm that's there with technology. I was shocked. Usually everybody's so metric-driven. When I asked him why, he said, Joel, it took us years to get our partner and team to give up the paper, to give up all these things, to go to the cloud. To take that step back culturally in IT, I'm not prepared to do again. I'm prepared to help someone improve their metrics before I'm ready to do that. So even IT is part of the culture that we have to see that makes sense for the two firms in some cases. And I will tell you, here I've seen so many firms that were taking over a firm that did a thorough due diligence, and how rare it was the firm merging up did any due diligence on them. At least on a credit report, if they're robbing from Peter to pay Paul, you don't want to wake up one day being Peter. So there's other things we'll talk about in choosing the right successor, but keep in mind, bigger is not always better. Better is better. I will say bigger is better most of the time, but for example, if I have a $500,000 compilation write-up tax practice, what's my main job? My main job's hand-holding. Do you think I'm going to take that practice and sell it to a top 100 firm, and they're going to have a partner hold the client hand that pays $5,000 a year for quarterly work? So you got to make sure that we're mixing the right things. But normally someone does have to be bigger if there's a succession aspect, so they have the capacity to replace you. But just being bigger doesn't mean they're better. There's a lot of other things you need to think about, some more obvious than others. For example, specialties and niches, which also falls into licenses. Here's a great example. If you're in the state of New Jersey and you do municipal accounting work, you must have a RMA on board, a registered municipalities accountant. It's only a couple hundred. It's the only state in the country that requires it. But very recently I was brought in to consult on a merger in New Jersey, and the firm merging up had an RMA, but that RMA was one who was looking to leave in the next year or two, and they had no RMAs to replace them. So do they have the expertise, the license, the specialties you have? One of the first things I would check if I'm a firm merging up is I'd like to know what the successor firm's own retention rates are. If they're having problems retaining their own clients, why would I think they're going to be able to retain mine? I get queried a lot about location. How far can I move my practice? And this you want to be able to move it as far as you can in a perfect world, because the wider the geographic area you have to choose from, the greater the quantity of possible merger solutions you have. If I'm merging up, this could be the last and most important decision that I have to make that relates to my practice. I want the largest audience possible, not the smallest. So I don't want to get stuck on location, but there are times and ways to determine how important location is. For example, if my lease was about to end, how far could I move the practice if I wasn't doing a merger and still retain clients? That should be how far I can find a successor if we do a proper transition, which we're going to be speaking to. Another telling thing is how many people come to the office. From a client retention perspective, if everybody's coming in through the cloud, through email, being visited, my location's meaningless from client retention, but it may be critical to staff retention. So location has to be looked at differently. I think a little too much emphasis gets placed on billing rates, because once read an article for the AICPA, The Great Mystery of Billing Rates. Here's an example of what I'm referring to. Very recently, we had a deal in Florida where it was a two-partner firm doing $1 million that the two partners who owned the practice were only billing out at $200 an hour. But they had no senior level staff, no junior level, no managers. They did all the heavy lifting with 4 or 5 paraprofessionals. At first, the successor firm was getting all panicky that their partner billing rate was $350 an hour. How could they do $200? So they looked into it and realized that smaller firm, 90% of the partners' work that they were doing would have been done by managers or seniors in the successor firm. The partners would have still had to do the hand-holding of the client and manage the client relationships, but they wouldn't have had to do the work. The people they would have used to do the work, they would only get $150 an hour. They actually would have been making more money on that. Sometimes it's the opposite. Sometimes I realize in due diligence that your quality control process isn't as robust as mine. It may take me more time and effort to drive the fees. So even though your fees may look good, it may not be good when I take over. So I've got to look at the billing rates. Big, huge part of it's culture. And you know, culture is a great term. It includes everything. And I could ask 5 different people what's the most important part of their culture. You could hear anything from IT issues to metric issues to dress codes, all sorts of things. Whatever's important to you in culture, you're going to want to make sure the successor firm has enough in common with that it's not going to impede client and staff retention. And again, a big part of culture are brand loyal versus partner loyal clients. Some cultures are tough to mix. For example, it's hard to mix an eat what you kill merger firm with another firm that operates under the one firm client philosophy. There's no my client, your client, they're all firm clients. But yet the other firm operates completely eat what you kill. My income's based on my own book of business, so I'll never share my clients. So some cultures are very, very challenging to intermingle. And of course, sometimes our successor we believe is internal. And if I have a partner level capacity to replace me, if I have staff strong enough to replace me, I'm in the rare position of having an internal succession solution. God bless, you're a very fortunate person, but some of these things will still, that we're discussing will still matter to you. I think when you're choosing the right successor, let's simplify it. Let's start with a very simple concept. Why do you have your clients? For 85% of you on the phone who are small firms, and probably a significant portion of the larger firms, I will tell you that it's highly unlikely any of you have one client who knows if you're competent or incompetent. If they knew that much to measure your technical skills, why would they be paying you to do the work that they understand so completely? Unless, of course, there was an audit involved. 99% of accounting clients have no yardstick to determine your skill set. So why do you have your clients? It's because of you. It's because of all of you on the phone today. You know, I hear all the time, what a great accountant I have. You should see the refund I got. Well, what does that mean? Maybe you'd go to jail if you got audited. Maybe the government shouldn't have your money interest-free all year. We know there's a plethora of answers beyond that. But they don't have a yardstick. So why do you have your clients? For most of you, you have partner loyal clients who have them because of you. So that, if you understand that, stop worrying about how deep someone's pockets are and how great their technical skills. They are important issues. But these 4 C's that we're about to go over are the most important issues that will help you maximize client retention and staff retention. The first one's chemistry. If you don't want to eat lunch with someone, don't merge with them. Again, if my clients and staff are comfortable with me and I'm not comfortable with you, why would I think my clients and staff are going to be? It's a huge, huge thing, chemistry. I'd say another thing that people don't think enough about is continuity. So, for example, if I'm one of those practitioners that are old school and I go out every quarter and spend a half a day with my clients, I can't merge my firm with someone who's going to say, well, you got to mail everything into me or do it on the cloud and we'll see you once a year. We have to think about continuity. Change is a very scary thing. Or what are we going to, if the successor firm is going to have to dramatically change the way we operate in matters that the clients and staff will notice right away, we potentially have a problem. And that's capacity. I've heavily advised several firms not to merge because they were just doubling their problem. Very, very recently, we had two partner firms who jointly wanted to hire us to help them do a deal where each of them had a partner that had wanted to slow down in the next 3 years. Neither of the two younger partners had any capacity. They were already working 2,800 hours a year. They had no staff strong enough to step up. What they were doing by merging together was doubling their issue. They weren't solving it. Capacity is very, very important. So choosing the right successor firm, if there were 4 things to remember, if there was 4 things to remember today out of this whole session, it's chemistry, continuity, culture, and capacity. If we're going to structure a deal, it's got to work for everybody. But these 4 C's are going to tell us in a much better way how it's going to work. Let me take a quick break. If we don't get you those polling questions, all this goes for naught. You get no CPE. Can you jump in, Nikki, and give us a quick polling question so I can rock on?
Sure. The next polling question is on the screen. This question is, in the past year, my organic growth was same as last year, grew but less than 5%, grew greater than 5%, or less than the prior year. So keep in mind this is our second polling question, and you need to answer 3 of 4 in order to get your CPE credit. So we'll leave it open for a few more seconds and let everyone have a chance to give their answer. Okay, Joel, it looks like it's a fairly even split. 31% say same as last year, 29% grew less than 5%, 26% grew greater than 5%, and then 14% chose the less than prior year option.
Okay. Well, I will tell you statistically, according to the AICPA and a couple other surveys that were done, smaller firms did grow approximately 5% in 2014. Larger firms grew a little bit more, a little over 6%. The problem with all those statistics is they don't separate between organic and merger growth. So it's challenging to say, but most people seem to feel they had experienced growth in the last year. And one of the telling ways that you can see that is what has become one of the biggest problems in our profession, staffing. If people weren't growing, we wouldn't constantly be fighting to go over getting the next staff member. And that's what brings us to the first part of the latter stages of today's session, and that is staff retention. We're going to end it more about client retention. Let's talk about retaining staff. Let's start with, what is the staff's fear? When they hear about that my firm is merging, what is their fears? Typically, their first fear is compensation. Is this going to change how I'm paid, what my perks and benefits are? It's a very, very quick thing that immediately pops into a lot of people's mind. Right after that, usually becomes security. What if there's 2 audit partners, managers? Am I not going to be the manager anymore? So how is this going to impact my ability to have a long-term place in this firm? And the third thing is, how is my role changing? Am I now going to have to work in a different office? Am I now going to be having to do different things that I'm doing now? So these are normally the 3 greatest fears the staff has. And just like clients, got to keep remembering, you're going to see this over and over today. Change is a dirty word. We want to focus on the gain of the successor firm, not the loss of the original firm. So we need to attack all 3 of these concepts and go forward with them. So let's take a little deeper look on how and when do we do that. Let's start by who people generally want to keep. Right? There are firms that hire us to help them do a merger because they're so short-staffed, they're doing the merger really to get more talent on the bench, in which case some of those firms are more focused on staff retention than client retention. The whole merger was about bench strength. Sellers have a different perspective. So what I find is the firms merging up or selling, they're usually looking at staff retention from a different perspective. One, a lot of them have loyalty. Right? One of the greatest obstacles I have can be sometimes the office manager. And small little sole practitioners and top 100 firms. I've had people who say, listen, this person's been working for me 38 years, you got to keep them. Of course, you could replace them for half what I'm paying them, and they get 25 weeks paid vacation, but you've got to keep them. I respect loyalty. Sometimes the successor firm, or rather the seller, finally realizes they have to pony up sometimes for loyalty. Matter of fact, very recently in a deal we did of a firm, it wasn't a giant firm, but it was a good-sized firm, $1 million going into an $8 million firm. They had someone that was like a partner to them, but not a partner. And they were dramatically overpaid. And the seller ended up saying to that person, look, I'm going to give you a piece of my purchase price, but they're not going to be able to have you make $100,000 more than everybody else in the same position you are. So I'm going to help you make it up. There are all sorts of things that have to be done, but sellers sometimes have a lot of loyalty. That's going to play into it. Where they should be focused even more so is client retention. Who's going to really impact client retention? Usually those are the people that have the most client contact. There may be someone who's fantastic, and hopefully the successor firm wants them. But if they have no client contact, they're usually a lot easier to replace than if they're someone who has a lot of client contact. So one of the things that you normally want to look at from both sides of the equation is, who do I have? Who is a must-have? Who's a preference? Who I'd like to see kept? Who's irrelevant? A must-have usually means client retention. A strong preference usually means loyalty. So each person is going to have a different look at that. Most of the time, the successor firm's focusing individually on staff based on, hey, how many chargeable hours did they do? What kind of client contact do they have? And how many changes can I make that won't scare my clients away? Because many times firms have certain redundancies when they merge, especially on the lower side, the clerical, bookkeeping, paraprofessional, secretarial side. How many people do I need to answer an office? How many data processors do I need? So usually the higher the functioning of the staff, CPAs, managers, seniors, non-equity partners, almost no-brainer they're going to be kept most of the time in today's world where people have so much problems finding good talent. I remember very recently Barry Melanson at a conference that we were speaking at said, if you're a CPA and you're unemployed, you probably don't want to work, or not to be negative, you're probably not that great, because we're at full employment in our profession right now. So if I'm acquiring a firm, I got to think about who is going to help me maximize client continuity. That's who I need to retain. Can I replace their chargeable hours? Maybe. But if they're really in contact with the client, maybe I should keep them at least for some sort of reasonable period of time. And that's one of the things I advise a lot of firms. Hey, why don't you keep everybody you can keep at least through the first tax season? Maybe you're going to find out somebody you kept is better than someone you had. Maybe you're going to find out someone that you kept turned out to be a great rainmaker. You don't know. Try and limit your changes at the beginning. The next question with staff that comes up a lot is, when should I tell them? Some people want to make the staff part of the process early on. And most of the time, I strongly recommend not doing that. I can tell you from personal experience, over the last 25 years, there were firms that came to me and said, listen, I'm looking to do a merger, and by the way, I've told my staff that we're looking to do something, and within the next month, certain staff members left. Why? Because as happy as they were, they didn't know what was going to happen. What if they did a merger and they weren't going to be offered a position in the successor firm? They were afraid. They wanted to protect themselves, so they started looking around and found opportunities. If you want to work as a CPA today, like I keep saying, you can work. So I find it very riskful Unless someone has a huge amount of influence in the firm and the clients is really a partner that just didn't have the equity, I find it very riskful to share with staff that you're contemplating a merger. You might change your mind once you start the process of looking into a merger. I don't usually make them part of the process. It's very, very risky. Once I have my deal done, I tell the staff. And frequently, I try and message things to the staff very similar to I do to clients. The question becomes how and with who. Some staff are going to justify a one-on-one meeting, bringing them into an office saying, guess what? Other staff might be a small group. And there may be other staff we bring to a firm-wide meeting and say, hey, guess what? This is what happened. But again, you need to address those three fears. I would never have someone in that meeting that you're planning on terminating next week, okay? But if your hope is to keep these people, then you've got to remember the fears. You've got to say, hey, by the way, I want you to know your compensation program is going to stay the same. Your roles and responsibilities will be the same. And now that we're part of a larger firm, we're probably more secure. We have a bigger platform of services. We should be able to attract more clients. This should help us give you even a greater security in your future, professionally and financially. The gain, not, hey, I'm leaving, now you have to do this different. It's look at all the great advantages we're going to have now. Always the positive, right? I like when people set up mentoring programs where they sit there and say, okay, when you come into our firm, you're operating very similar to Jane is. Jane's in the same role. She's been with us for 6 years. She's going to be your personal mentor. She's going to help you with how our technology works and everything. These mentoring programs are a way that make the new people feel comfortable, immediately creates relationships between the original firm and the new members coming in. Fabulous way of doing it. And one of the things you really want to do is create very specific goals for new people. Hey, I'm hoping that you're going to be able to understand this system within this period of time. I'm hoping that you're still going to be able to knock out this much chargeable hours, whatever the appropriate thing is. But it's very hard to measure success of staff and comfort level if there aren't some sort of yardsticks put into place for them to understand what their goals are and how to measure them and how to go about it. Now, one of the keys for a lot of us in merging in staff is understanding what kind of obligations we have, not just financially, but what about client confidentiality and non-competes? So one of the first things as a successor firm I should do is look at the smaller firm and say, well, do you have employment agreements? If you do, let me look at them. Are they assignable? How do they work? If they don't have employment agreements, you're probably going to make that part of the new rule for when they merge into your firm. And there's ways to do that scare people, and there's ways to do that give people a comfort level. Scaring people is saying, hey, you just got to sign this, you know, and putting it out there like as if they need a lawyer to start reading everything. Conversely, the more comfortable way is saying, hey, we want you to feel secure and understand what your compensation is. We're putting it all in black and white so you feel good about it. And of course, in this 1, 2, 3, 5-page document, whatever, there's going to be a paragraph about non-compete, and there's going to be a paragraph about confidentiality. If you make the whole thing about the non-compete, it scares people. If you make it a part of the whole thing, it's less scary. And let's be realistic in our non-competes. I can't tell you how many firms I look at the employment agreements, and they'll never hold up. You know, if we terminate you, you can't be a per diem, you can't do anything within an X mile radius for 5 years. Nobody's going to hold that up, right? It's very hard to stop someone from making a living. What you can stop them from doing is raping your practice. So usually 1 or 2 years from the time they're no longer there, if a client of yours happens to become a client of theirs, they're going to have liquidated damages, not a penalty. Penalties in many states won't hold up well. Liquidated damages. So you have to be very careful and know what's reasonable to have in your employment agreement. One of the other things that people seem to worry a lot about are compensation systems that don't exactly match up. Now, I will tell you, it's a big problem if my senior's making 150 and yours is making 80, because eventually they're going to find it out. But where you usually see bigger issues, not bigger issues, but issues that people have to face all the time is, here's a simple example. In our firm, we got 3 weeks paid vacation. I'm merging into a larger firm. They only give 2 weeks paid vacation. How do we overcome that? Well, it's just a simple example, but I might tell the firm that had 3 weeks paid vacation staff, look, we're going to give you all an increase of salary based on 1 week. but you only get 2 weeks paid vacation. You can take that third week off, but it's without pay. Now what you've done is you've kept them whole in income because they could take that third week off. It's figured into their numbers, but you haven't given them Rule A and everybody else had Rule B. I see it all the time. We do it in mergers with partners, where each of us could have a car lease through it, but the value of that car lease comes out of our total gross compensation package. You'll see articles on our website under the resource section that talk very specifically about overcoming compensation differences, perks, which includes perks, benefits, and things like that. But when you're transitioning and looking to retain staff, the first step is to identify the pecking order of importance. Who's going to be critical because of their skill set, because of their client relationships, because of their position in the firm, and make that scale down. The people that are the most critical are the ones you need to focus and have the best plan on. And those are likely people that you're going to have the individual meetings instead of the gross meetings. A key thing, again, and where we're going to spend the rest of our time, is on client retention. There's a huge amount of aspects of client retention that everybody focuses on the obvious side. Most of us that lose a client, lose them for the small reasons that not enough people think about. So we start by, how do we get this word out to people? What is the message we want to send, and how do we want to send it? So for example, one of the simple things I'll do is, when I'm acquiring a firm, I'll take all of the clients and I'll put them into categories. First categories I'll put them into is broken down by industry. Let's say doctor group, wholesale, retail, 1040 only, whatever. And then in that, I will also put them in decreasing revenue, what they produce annually. Then in a very quick piece of paper, I have who's in what niche, and who's the bigger client, the more lucrative client, things of that nature. Then I could start by saying, okay, who gets a phone call, who gets a visit, and who gets a letter? I'm not going to send a $50,000 a year client an announcement letter. I'm going to go visit them. I might not go visit a $500 tax return client that mails in the work anyway. I might they'll probably just get a general announcement letter. So the clients in between will probably get a phone call. But we have to start by who gets a phone call, who gets a visit, and who just gets a letter. If it's a visit, let me give you a hard lesson that I learned in 1991. Had a gentleman, his name was Murray, went to his biggest client, told him all about the merger he was doing with this firm, and Jane and John were going to be his successors. And when he finished this whole beautiful speech that he prepared, the client said, Murray, that's great, congratulations, but you're the only partner I want on my job. Cut him right off at the knees. If Murray would have brought John or Jane with him, that client would have said, John, nice to meet you, never want to see you here ever again. What Murray did by going out to see the client alone was empowered the client to be the decision maker. Instead of sharing the fact that, hey, here's my new partner, John, he's an expert in your profession, we're going to charge the same fee, the message that we'll talk about in a minute that has to be sent. So it's not just who gets a phone call, who gets a visit, who gets a letter, but who attends the visit. Who does the letter come from? Is it jointly coming from people or individually? Right? I do want to spend a minute on firm names before we go further. I will tell you on a personal basis, I think there's nothing more overrated than the firm name. I have people all the time say, my name's not in the firm, we're not going to keep clients. Well, I have to tell you, I have not seen evidence of that, and I've done more deals in this country than anybody you'll speak to throughout the nation. People are loyal to small firms are very loyal clients usually, but that doesn't mean your name has to be in the firm. That's not what they're worried about. They're worried about whether or not you're still going to be there. We're going to talk about the client fears in a minute. But I will tell you nothing more overrated than name. For those who want to make a big deal about name, sometimes you're opening Pandora's box. If we're a small firm and you want your name in our firm, and this is a succession plan, you're going to have equity. Now you're going to have a lot more liability and exposure. What do you want that for? If you can be held out as a principal, if we can put together a plan that's going to retain the clients, why would you want the liability and exposure of ownership on top of that? One of the ways you can circumvent that is, let's say Nikki bought my practice. Maybe for the first year I could have Joel Sink and CPA PC division of Nikki. That you're allowed to do. That's not a DBA name, division of. You'll see it many times with a big firm merges in a smaller firm. I remember in 1992, I did a deal between two firms who were both gone, Weineck Sanders and Traeger Glass. Traeger Glass operated under Traeger Glass division of Weineck Sanders for the first 2 years, I believe. These are things that most states accept, which is most of the Board of Education, the AICPA, etc. What they won't accept most of the time for CPA firms, a DBA name or someone's name in the firm that wasn't an equity partner. See, if I'm a retired equity partner, as long as there's 2 equity owners or more, they can keep my name in it. But if it's sole practitioner, after I leave, you can't keep my name in it, technically. But let's not get focused too much on name. Let's focus on the messaging. And in order to understand the messaging, we need to focus on what are the main fears of clients. Before we do that, let's take our third polling question, and then we'll march to the end.
Okay, thanks, Joel. The third polling question is actually about client fears. It says, what are the major fears clients have when they hear of a merger? And your choices are that fees will increase, that they may no longer work with the same people, they may relocate the office far away, or all of the above.
All above. I didn't say anything.
We'll give you just a few more seconds for this one.
I guess I should have answered the question before we asked it, but that's okay.
Okay, we've got the results in. 80% of folks said all of the above, with fees increasing and no longer working with the same people, about 10% each.
They're all right, because it really is all the above. Let's talk about what are the 4 greatest fears most clients have. First one is the person I trust still there? That's referring to the owner or partner they work with. The second one is this going to cost me more money? The third one isn't for everybody, but for those who visit their accountant's location, is it going to remain geographically sensitive? And the fourth one, again, which isn't for everybody, but if I deal a lot with a staff person, is that staff person going to be there? My company is a great example. Half of my partners in this team are CPAs, but we have an external firm that we work with. And the manager of that external firm knows more about our business than the partner. If they did a merger and that manager wasn't there, I'd be way more concerned about my continuity than if the manager wasn't there. So these are your 4 issues. Now, let's see how to package them, tied into what we just discussed, by using an example of an announcement letter. Again, not everybody's going to get an announcement letter, but we're going to use that as an example. So let's say that we go back to that list I prepared of what profession, what niche each one's in, or specialty, or industry, or service, what fee they get. So let's say that I'm sending a letter to a doctor who's in a doctor group. And let's say that I did a deal with Nikki again. In order to overcome all 4 of those fears, here's how my opening paragraph in the letter is going to go out. And that letter, because I'm the seller or mergee, is coming from me. I'm going to say, Dear Dr. Smith, I'm pleased to announce that I've merged Nikki into my firm. Nikki is an expert in the Obama tax laws and the modern computerization of accounting, especially as it relates to the medical profession and Obamacare. Together, we'll be able to operate and offer you additional services, yet maintain the same fee structure. I will remain the principal in charge of you as a client. The same staff you're used to dealing with are part of our new combined dedicated team of professionals. And we remain geographically sensitively located here in Kansas City, Missouri. In the first paragraph, I overcame every issue. I'm still there. The fee is the same. I brought in an expert in your profession who's working with me to help service you even more under the same fee. We're in the same general area, and our team's still there. If clients are loyal to me and they got that message, why would I lose them? As counterintuitive as this sounds, the greater the loyalty between an accounting firm and their clients, the easier it should be to retain them in a merger or an acquisition. So if it's a letter, let's also look at an example of the little things. Now you'll have to see how my wife has to deal with how anal I am. But since 1993, we haven't sent out an announcement letter that didn't go out in the seller's or mergee's original envelope. Why? We found when we were sending them out in the successors envelope, many people never opened the letter. They thought it was a solicitation from an accounting firm. but your clients open a letter that comes from you. So typically, the letter, the envelope, will come from the seller or mergee. The internal stationery will be the successor firm. Sounds silly, very important. Just like who answers the phone. If I don't answer the phone generically at the beginning in the accounting office, or you reach the offices of Joel Sinkin and Nikki, some people may hang up. They think they just dialed the wrong number. If we answer at Nikki's office, can I help you? So it's the little things you need to think about, the message you're sending. And although I used this letter as an example, the content of that letter is the delivery of what you do on a phone or on a personal visit. Again, we're focusing not on the loss of something, but the gain. And we're trying to overcome those fears right off the bat. So we use that age of specialization. I've merged with someone who's an expert in your field. We're bringing a value added. We're careful that when the phone is answered, we say either generically accounting office, you reach the offices of both. I want the same voices when possible on the voicemail. Right? I want to be very, very careful on all these little things. All right? And I want to sit down with the new staff and work with them constantly on how to become part of the same team. Asking them for their input, their ideas, where they're struggling. If you look at the research on staff retention, you'll find that the people that feel they have a voice, they have a say, that they're part of the process, are more engaged and easier to retain. So these are some of the important things we're going to do with the clients. And again, in the announcement letter, we're going to use those 4 things. But then the 2 other things you need to think about is what's the timing of making that announcement. For example, I love when I close a deal right before tax season, because before they even have a chance to think about it, boom, we're right in their face. But a lot of deals close in June, July. That's not a bad thing. But 87% of our clients we only see during tax season. It's not just the 1040 clients. It's all those people that work on the cloud and staff that the one time we see them might be tax season. We close a deal in June, we're giving them 8, 9, 10, 12 months to think about it. So you've got to be careful on your message. In a perfect world, even if you close your deal in January or February, if it's not effective till June, at least you get to start planting seeds. And say, hey, I'm merging with John and Jane Doe June 1st, but our fee's going to be the same, everything's the same, blah, blah, blah. You never, though, hint that you're doing a merger unless you've done it. Don't scare your clients just like you shouldn't scare your staff. When the deal's closed, you do your announcement, you focus on the gain, not the loss, and sometimes you stage things. For example, if I close in June, to my 1040 only clients, I might not even send an announcement letter until January when I send them the tax organizer. But everything I'm going to do, I'm going to say, what are the possible objections people are going to have? How do I overcome them in my messaging before they even bring it up? How do I take a possible negative and turn it into a positive prior to that? One of the questions I get asked frequently is, how long does it take to transition a client? And a lot of people don't get this part of it. First of all, a lot of it depends on how often you see the client. If I see a client every month, in a year I'll have 12 opportunities to do introductions. I could transition that client pretty quickly. If I'm a large firm and my client's brand loyal, I could transition that client pretty quickly. But if I only see a client once a year, and they're a very partner loyal client, that means, let's say it took me 3 years. It sounds like a long time. It's only 3 visits. See, the 13th Amendment prevents slavery. You can't buy and sell people. You need to have a transition plan. You need to have time to do it. So now that we spend a huge amount of time communicating with clients, more than we ever have, but we're spending less and less face time with clients. So if I'm one of those practices that the lion's share of the clients I only see in the same room with me once a year, I'm looking at 3 to 5 years to do a proper transition. But that doesn't mean I have to work 3 to 5 years full time. I had someone say to me, Joel, if I don't work, I got to put in my 2,500 hours for the next 3 years to transition. I said, no, you don't. He said, but you said it was 3 years, at least 3 visits. I said, I didn't say you had to work full time. I said, the messaging. So I gave him a little bit of a shock, and this helped him get his arms around it. I asked him, forget about phone calls, emails, forget about everything. Just personally in the same room with your clients. How many hours a year do you think you're physically in the same room with your clients? Gave it a lot of thought. He said probably about 225 hours. I said, so if in 2015 you spend 225 hours with the clients, how would they know any different? It's packaging. It's not reality. If I need you to do the work, I chose the wrong successor. It's the message I sent. So I want to hold myself out as being involved and most likely welcome to be involved. But I could be reducing my chargeable time. I could be reducing my responsibilities, but still have the image of being there to do a proper transition. So it's not how many chargeable hours you put in. It's the message we send and how we send it. All right? So the more often frequent I have client interaction, the more opportunity I have to transition them. The less frequent, the less opportunity I do. The more partner loyal, the longer it's going to take to transition them. The more brand loyal, the less often. Now, one of the things you want to do is, one of the issues I run into a lot is, hey, I know I need 3-4 years to do a proper transition, but I don't want to give up income or control. I don't want to be someone's clock-punching person, as we clean that up. I don't want to have the accountability of being like one of the I've been master of my own domain. I'm not going to give that up. Therefore, I'm not going to be able to do a proper transition. Silly thoughts. Correct in the initial premise that it's going to take me years, but you don't have to always give up control. One of the ways that we've overcome this is a two-stage deal. A two-stage deal basically works as follows. During stage one, we calculate what the owner's net is. All right, so and what the gross is. So let's say let's use a small example. I'm an $800,000 firm. I net 40%. And the way I'm able to net 40% is I have one full-time manager, one full-time senior, and one full-time paraprofessional. And with those 3 staff in hand, I'm netting 40%. And let's say I want to work 3 more years full-time before I slow down. Well, we've created the premise of stage one. We now know what my gross and what percentage of revenue I'm bringing in and how much labor I'm using to do that. The successor firm during stage one takes over all of the costs of operations. So I'll move you into me. I'll take over all the overhead. And if you were making 40% of what came in last year, I'm going to pay you 40% of what comes in this year. And usually this is structured as my entity to your entity. So therefore, if I'm paying you 40% of what comes into your entity continues to pay your car lease and your medical insurance and feed your retirement plan. All the tax perks and benefits you used as an owner remain the same. The only difference is instead of running 100% of the revenues through the firm, you're running 40% and whatever expenses you choose to do. So the buyer's getting a current deduction. The seller's still getting all of their benefits, tax advantages. And in this particular case, by the way, I don't even care how many hours the seller puts in. Because if the seller puts in 2,000 hours or 3,000 hours, that may not impact my pocketbook. What's going to impact me is how many hours of support I'm giving that seller. If they were using, let's say, 2,000 hours of manager, senior, and para time each. So this is how we go in this two-stage deal for a small firm. See, think of it, the benefits now. Now I'm an owner. I was making 40% of what came in before. Most likely the successor firm is going to take over a lot of the admin, the billings, the collections. So I'm actually going to be able to have less responsibility. I'm not going to have equity, so I'm going to have all the advantage of ownership with none of the liability and exposure of it. There's really only 2 ways I can make less money as the seller during stage one, and this is the kicker that helps protect the buyer. The first way is if my fees go down, because I'm getting paid the same percentage what I was making before on a revenue base. But if my fees go down and I don't do this deal, I get hurt even worse. Think about it. If I lost a $50,000 client and didn't do this deal, I'd probably lose $50,000 in income. All my other expenses are fixed. If I do this deal, I only lose 40%. So it mitigates the issue. The other way I'd make less money is if I suddenly needed more labor than I used in the past. But if I didn't do this deal and I needed more labor, I'd have to pay for it. So in this situation, the successor firm might say to the seller, look, I'm going to give you these 6,000 hours of labor in the categories you told me. But if you need more than that, you're going to have to pay for it. That's why I probably don't care how much time you put in, because that doesn't affect my pocketbook. But if I have to give you more support, that does. In a larger deal, we're in the middle of taking an $8 million firm into a top 100 firm right now. 2 partners are doing a 2-stage deal. But for them, it's not just about that. For them, because it's a large firm, we based it on chargeable hours. They were each putting in about 1,300 chargeable hours. We said as long as you continue to do it and the revenue stays the same, you'll make the same money. So small firms, we usually don't base it on the owner's time. We base it on the staff's time. Larger firms, we usually base it on the owner's time. So from a seller's perspective, it's like a practice continuation agreement, because if I get hit by the bus, we go right to stage 2. I have backup and support. I have guaranteed succession. Because I'm doing a great transition, client retention should be much happier, much better, and therefore I make more money. Why does the buyer do it? The buyer does it because in this example, which reminds me of a deal we did in Chicago not long ago, an $800,000 firm. That firm was paying about $58,000 in base rent. They had a para that we didn't need to keep, and they had a per diem we didn't need to keep. By moving that firm into the buyer's office, they saved about $150,000 in overhead redundancies. That all went to the buyer. Now, I will tell you that the seller called me up a week before closing and said, hey, they're making $150,000. I should get some of that. I said, no, you shouldn't. You got everything you wanted: backup, support, succession, autonomy, control, income. The fact they're making some money is why they're doing the deal. Don't take away their incentive. So everybody wins here. Stage 1, the buyer and seller all win. We're doing a great transition plan that's going to retain the clients. And the stage 2, hey, that's the buyout. See, I can't keep you holding income and pay you for your equity at the same time. So by deferring the purchase price until you reduce your time commitment, I could keep you holding income and pay you a good multiple. But I can't do them both at the same time. So stage 1 ends typically when the seller reduces their time commitment below a certain period of time. It's usually tied into a back date that they must retire by a certain point in time unless mutually agreed to extend. If there's a retention period, which in most deals there are, big deals there aren't, small deals there are, the retention period usually starts at the onset of stage 2. But remember, we did a great transition. Usually the seller stays on in a part-time role, plus get a new business incentive clause, and they get a purchase price. So whether you're small, so understanding a 2-stage deal could be a great tool to increase client retention. Smaller firms, you need a little bit more time, but you don't have to give up control, autonomy, and income. You can do it in a 2-stage deal. Bigger firms usually have some partners who are looking to stick around forever, some looking to get out. We can go to one firm, do one deal, a 2-stage deal for the senior partners looking to slow down, and a regular merger for the others. Understanding different deal structures will teach you better on how to do deals. Some will get an immediate sale, some a merger, some a 2-stage deal. If we focus on what are the fears of the clients and what are the fears of the steps, we can make this deal work. But don't procrastinate. It takes years to do a really good transition for the smaller the firms. Find the right successor, structure a deal, close the deal, integrate the firms, and start working on client relationships. Start making this the focus of growth, not shrinking. So this is the Reader's Digest version of this. On our website, under the resource sections, a bunch of free reports, articles go into detail about ownership transition and integration. You'll find a lot of things that will help you. Hopefully you got your value out of it. Stick around so we can ask one more polling question, because if you had to listen to this New York nasally sound, you might as well get a CP credit out of it. Why don't you finish us up there, Nikki?
Okay, sure. I've gone ahead and launched the last polling question. This one is about your current firm goals. Is your goal to grow through merger and acquisition, transition your practice in the near future? Some partners are looking for growth and others for succession, or staying the same. And then, Joel, while we have everyone finish the polling question, we did have one question come in about staff. Now, the question is, what if there is staff that is way overpaid but you want to keep them? Do you offer to keep them at a reduced/fair market rate, say after tax season, so that you can keep them through tax season into the transition?
You know, keep in mind that when a seller, let's say in a 2-stage deal, for example, a seller's making 33% and overpaying a staff person. If they were paying that staff person correctly, they would have been making 40%. And in a 2-stage deal, if we were keeping them whole in income, we would be paying it anyway. So it depends. Is it a regular deal? Is it a 2-stage deal? My bottom line would tell you this. It's very hard to say to someone, put in the same time and effort, have the same responsibility, and make less money. So part of it means we're going to have to negotiate a lower valuation with the seller if they want us to keep that client, that staff member, because it's mitigating our profitability. But I'd usually keep them at least through the first tax season, make sure that we're getting our proper transition, and then if I had to make a change, I'd make a change. That's a really quick answer, and I know we're out of time now. Anybody who has more questions, email them to them. It's an evergreen thing. Ask the question, you'll get an answer for free. You want more detail, don't hesitate, give us a call. Because each thing is unique. But it is a big problem when you have a staff member making twice what everybody else is. But sometimes you have to eat it. Sometimes it's a matter of the seller cutting that staff member in on some of the purchase price. And by the way, that makes a lot of sense for a seller sometimes. Hey, I'm going to give you 5% or 10% of what I get as long as you stay there. That's an incentive for that staff person to stay there, which might help that client retention, which might help the seller get paid more. So it's just it's a hugely important part of the equation, but it's just a part of the equation. And it's hard to answer without having more info.
Okay, well, thanks, Joel. We did have a couple other questions come in right at the last minute. I'll be sure to send those on to Joel, and he, I'm sure, will be happy to address them. I just wanted to thank everyone again for attending today, and you'll receive a link later this afternoon to an evaluation if you registered through us, through Transition Advisors. Once you've completed that, then I'll be issuing your CPE certificate via email. You see Joel's information on the screen there. Feel free to reach out to him if you have any questions.
And you know what, Nikki, those people who I didn't get the questions, I apologize, but I assure you that if I get them today or tomorrow, you'll have the answers before the weekend.
Great. Thanks, Joel. All right, thanks
Thank
everyone
you.
for attending.